Good afternoon and welcome to the Future of Finance, where we will discuss wealth managers' need to take a side on cryptocurrencies and security tokens. I shall now pass you over to Dominic Hobson and the panel. Thank you.
Hello everybody and welcome to our webinar, Wealth Managers Need to Take a Side on Cryptocurrencies and Security Tokens. I'm Dominic Hobson, co-founder of Future of Finance, and I'm delighted to moderate our discussion today. Now, when we last visited the subject of wealth management back in October last year, we found that wealth managers were struggling to keep up with technological developments. They lack the money and they lack the knowledge to digitize their offerings, which helps to explain why, as the Khalifa report of February this year found, wealth techs make up 35% of all fintechs in the United Kingdom. Clearly, digitizing wealth management is a big new business opportunity. So it's scarcely surprising that we also found in October last year that most wealth managers are not yet ready to embark on investing in those digital technology-driven investment vehicles we know as cryptocurrencies and security tokens. But the fact remains that wealthy investors are natural pioneers of cryptocurrency and token investing, and their wealth managers could definitely help them make that journey and profit from it. And not just by putting on additional risk either. Ruffer Investment Management, for example, a wealth manager whose entire sales pitch is safety first, famously bought Bitcoin late last year to protect the capital of its clients rather than augment it. So there are good defensive as well as offensive reasons for wealth managers to get involved in cryptocurrencies and security tokens. Now, to help us get a better idea of which wealth managers are doing what the benefits and the barriers to their entry are, and what roles wealth managers can actually play, I'm joined by 5 people who've been thinking about all of these issues for much longer than I have. Ali Ben-Ari is the founder and CEO at Applied Blockchain, which develops blockchain applications and products for major corporations in multiple industries, including financial services. The product set includes Beyond, a confidential trading platform, and K0, an open source zero knowledge proof framework for trading assets privately on smart contract blockchains. Phil Gillespie is president and CEO of the Japan arm of B2C2, the cryptocurrency market maker that works with wealth managers, family offices, private banks, and hedge funds seeking liquidity in the major cryptocurrencies as well as the major currency pairs. Trevor Goodman is a managing director at MJ Hudson, an asset management consultancy specializing in private equity, whose clients include wealth managers, private banks, and family offices. MJ Hudson is also a sponsor, among many other things, of the Private Markets course at the Said Business School, birthplace of the Future of Finance. And nothing is more pertinent to our discussion about tokenization today than private markets, where the techniques which some think will one day sweep the current securities markets away are being pioneered. Jeff Harvey-Wells is a sales manager at Avaloq Wealth and Private Banking Solutions, which provides wealth managers with the technology they need to invest in digital assets on behalf of clients and indeed tokenize client assets. Andy Knox is a former chief of staff at Man Group with an interest in financial technology, who is now consulting to asset and wealth managers on strategy, clients, and communications. In addition to our panelists, we do also have you, our audience. We want your questions and we want your comments, so send them, keep sending them using the Q&A functionality at the bottom of your Zoom screens. Rest assured, I won't be saving them all up to the end, but I will answer them as we go along. So you will be, if you choose to be, an integral part of this discussion right from the start. And all 6 of us will be disappointed if you don't take that opportunity. I'd like to begin by asking our panelists whether they think cryptocurrencies are now a mainstream asset class, and of course, whether security tokens will one day become one. Because if these assets are going mainstream, wealth managers need to do something. The question is, are they doing something? And if so, what is that something? Now, Jeff, I haven't been able to source any meaningful statistics about what's going on in this marketplace, but you must be talking to wealth managers all the time. Are they crazy for crypto and gagging, frantic for tokens, or are they a bit nervous about both of these things? What's the evidence you're seeing in the marketplace?
Thanks, Dominic. I think at Avaloq, we have about 150 wealth and private bank clients. So I think it gives us a unique perspective on the market. I think there's definitely a change. I think that the market thinks it's now the right time for the banks and the wealth managers to get involved in that crypto asset investment process and then use that in terms of the portfolios that they manage their clients with. I think 5 or 6 years ago, there was nervousness. I think extreme volatility and complexity over the crypto assets was an issue. We see that easing today, particularly with the cryptocurrencies. I think that's driven by the customers of the wealth managers wanting to have that cryptocurrency as part of their portfolios. I think the interesting change is twofold for me. I think initially the clients are driving their wealth managers to involve cryptocurrencies in their portfolios. I think the wealth managers themselves are now involving cryptocurrencies in some of their strategies going forwards, and whether that's funds or investment solutions that they offer the market more generally. And you mentioned tokenization, and we see tokenization as probably the next big wave after the cryptocurrencies.
Mm-hmm. Thanks, Jeff. Phil, you must be talking to wealth managers every day as well. Does your experience match that of Jeff, or the clients you're talking to are by definition more advanced? But do you feel yourself riding the crest of a wave, or what?
Yeah, I think in terms of the crypto market as a whole, it's becoming more mainstream. I mean, just a few years ago, just 2-3 years ago, it's mainly retail driven still. But in the last year and a half, we're starting to see not only banks, corporates, and family office and everything else is kind of coming in. So, I mean, a lot of us are from traditional finance, from Goldman or JP, used to do FX market making and so on. And we're starting to see these traditional client base coming into the crypto ecosystem. So it's definitely becoming mainstream. But with regards to wealth managers, I think it's still early days. I think there's a lot of, and I think we're going to be talking about it today and a lot of these questions, but I think there's still unfamiliar kind of territories and still reluctance for a lot of guys to be fully committed to the crypto ecosystem. But we've seen a tremendous amount of change in the last 6 months, last year, and in the overall client kind of base.
Trevor, you mentioned shortly before we went live a few minutes ago that Jpmorgan has launched this Bitcoin investment fund yesterday, I think. Now, as you hear what Phil in particular has been saying about the relatively low level of knowledge of wealth management, what's going on in this marketplace, maybe funds and ETFs can be gateway products for wealth managers to get into the cryptocurrency asset class first, and then maybe tokenization comes later.
Yeah, I think that's right, Dominic. I think that's a really, really good point. And when I've looked at things from a legal regulatory perspective in this sort of area, it is around bringing the fund structures virtually on sort of blockchains and looking at the different types of assets that maybe could be put into those fund structures. So that's definitely a development. I do think the Jpmorgan announcement is a really interesting one. Obviously, they had previously announced they were going to sort of get into the custody space around crypto, and they're clearly beginning to start to join the dots across their organization, their complete offering, and absolutely it's becoming mainstream. And I know that this isn't for this particular conversation today, but even sort of the Bank of England beginning to try to take a lead on a central digital asset, digital money as well. So when all of those things are beginning to happen, it's very clear that if you don't start moving and looking at the issues and developing a strategy, you may get left behind, and there's going to be a lot of disruptors to the current legacy players in the industry. So you need to really understand what's going on and have a plan in terms of what to do.
Yeah, no, you're quite right to allude to the fact central bank digital currencies will affect everybody, including wealth managers. That's the one aspect of this you simply can't escape. But Andy, perhaps you could give us a few thoughts. I mean, there are lots of ways in which wealth managers could react to this opportunity, this threat. They could start advising clients on how to invest in these asset classes. They could start, as some private banks I know are doing already, starting to execute, direct transactions on behalf of clients in crypto in particular. They could start to develop a business structuring issues of security tokens by their high net worth or ultra high net worth clients. Do you see much evidence that wealth managers are actually doing any or all of those things?
Yeah, well, I think just picking up on something that Phil was saying earlier, I think 3-4 years ago, it was a very retail space, but that retail space kind of existed outside wealth management, which is typically kind of mass affluent plus, right? And I think over the last year or so, you've had high net worths and ultra high net worths leading because they've been saying, I don't care if you're not familiar with it. This is an asset class I'm interested in. we haven't talked about, currency exchange controls and all the rest of that, right? That arguably driving huge amounts of volume. Lots of rich people looking to use Bitcoin as a safer haven in some ways than the dollar or their local currency. But I think what's happened, and Avaloq as one provider is onto this, is that means wealth managers have a custody challenge, because if they don't help their clients custody crypto assets, there's a risk that they might lose them to challengers. So there's that whole, so it feels like a lot of the kind of wealth management action in the space right now is driven by custodying as an additional service for clients. Then you've got all the hot cold wallet stuff, etc. But there are, as you say, multiple angles to this. I mean, you saw Bailey Gifford investing recently 100 million in blockchain.com. So there's a whole investable asset class side to this. And then, I mean, the security tokens piece is particularly interesting, I think, for wealth managers. It feels still 2 to 3 years off, but the ability, some of the kind of basic attributes of DLT, like fractionalization, immutability, all the rest of that opens up all sorts of possibilities across all the collectibles, but private assets as well. And what's really interesting on top of that for wealth managers is, as you were kind of alluding to earlier, a lot of the value that they might seek to add is in structuring, right? So they're bringing together different exposures. And if, a lot of the flows of the last few years been into multi-asset, there's a really interesting kind of future, maybe 3-5 years hence, where clever structurers at wealth asset managers are slicing and dicing exposures to various asset classes in a way which hasn't been possible in the absence of that technology.
Well, your point is that even if wealth managers are not actually advising clients on this, they need to look at this as an investable asset class. They need to develop products to safekeep these assets because clients want to hold them. But I'd like to pick up just I'd like to pick up the point you made about new asset classes, and I'd like Addy to comment on that in a minute. But before we do, I'd just like to ask Phil, because you mentioned, Andy, people are using Bitcoin, certain types of clients are using Bitcoin as an alternative to holding currency. And this will ring all sorts of alarm bells with certain wealth managers, that this is all about the dark web and tax evasion and sanctioned individuals and politically exposed persons and so on. Now, Phil, you're obviously a regulated firm. What's your opinion about how regulation in the markets where you're operating is actually treating cryptocurrency as an asset class now? Are we in a way starting to see more activity in cryptocurrency in markets where there is a kind of regulation in place for this than in markets where there isn't?
Yeah, I mean, the answer is a little bit tricky because it's relative. Some regulatory changes are a bit crushing because it's just too strict. So what we notice is that depending on a country like India, who's outright banned cryptocurrency, versus other countries who's actually set up regulatory framework, which in turn provides clarity in terms of business, right? I mean, the problem is, when you have institutional clients that want to do business and they want to invest in crypto, if the regulatory landscape and if there's no regulatory clarity, it's hard for them to come in and establish a business or try to sell or own crypto on their side. So what we've noticed is that right now in Asia, the regulatory landscape is getting very clean. In each kind of jurisdiction, we have an office in Tokyo. We do a lot of business across all the different Asian countries. But my feeling is that right now Asia has kind of matured with a lot of these regulatory kind of setup, and now we're going to start seeing Europe and the US kind of follow suit as well. But I think from an institutional perspective, you have to have regulatory clarity in order for you to actually conduct business. So in the long run, this is the right thing and kind of the right path forward. Can
I ask you an unfair question? Is the UK on the right path Everybody, do you have a regulatory framework you can work within?
Given that we're an FCA regulated company, I don't think we can comment too much. But at the same time, we are a UK company at the end of the day, and we are, providing liquidity through a UK firm. So I think, there's always complaints from anybody who's a crypto participant, because there's just so much banking scrutiny, regulatory scrutiny, and so many things that we need to deal with. But at the end of the day, the fact that our headquarters in London is a testament to at least the UK framework that works for us for the business wise.
Yeah. Your clients could be confident their counterpart is not a sanctioned Russian individual. All the FATF and AML and KYC has been done. So that's really what I meant. Now, Andy, perhaps I could bring you in at this point. Andy mentioned these new asset classes which are becoming available. And we hear a lot about private market assets, by which people mean everything from real estate through private equity, private debt funds, and indeed just private company equity raisings and debt raisings. But it could also mean not just real estate, but forestry, fine art, collectibles, I think Andy referred to now. Do wealth managers need tokenization to access these asset classes? They obviously make it easier, but are they excluded from investing in these asset classes by the system as it exists today?
Yeah, I think the answer and what we've really seen happen in the last 6-12 months is liquidity. So the big change in this space is that a lot of activity has moved onto these public blockchain networks, and the cryptocurrency space has obviously exploded. We're growing substantially, and we've got more and more institutions dealing with it directly, who wouldn't have done 12 or even 18 months ago. We've also got just a new type of infrastructure that's being built on top of this. So we have things like decentralized exchanges, which offer certain types of efficiencies. We have more and more applications of decentralized finance, which are autonomous financing vehicles that run on this type of infrastructure. And these are still they're fairly experimental, but they all interlink, so they all work together. So if you take a piece of art and you deploy an ownership record onto one of these networks, you can try to finance it using one of these decentralized financing contracts, and you can present it to one of these liquidity pools to try and sell it, and it's all interlinked and very, very efficient. So that's really what we've seen as a massive shift in the last 12-18 months, from institutions experimenting with private blockchains, which felt safe in that they were ring-fenced and controlled by the institutions themselves, but they didn't have the liquidity, and we're really seeing a movement by the institutions themselves towards these public venues. Now, of course, some aspects of the public venues lack KYC and lack some of the standards that some of these institutions need, and so there's various tooling popping up to deal with that. But that's still, there's still a lot of work to be done there. But the growth of liquidity itself in those venues is really what's generated the excitement and is kind of feeding itself now.
Dominic, can I add something there? One of the themes that we're seeing is that wealth managers have started to talk about this tokenization of these assets as a way in which they can increase their market share to, if you like, lower wealth clients, so the mass affluent rather than the ultra high. And you mentioned a piece of art there, Addy, and it's a really good point that actually somebody could sell that piece of art to 10,000 people who otherwise couldn't even afford a piece of art, and could have some kind of ownership and benefit from that as an investment. So we see that as a trend where our clients are looking to broaden their client base out, and maybe to take those services and experience they've got with the ultra high net worth clients and offer them to the mass affluent clients.
I see a synergy there. Those rich people are the people who tend to own fine works of art and collections of vintage motor cars, and they could keep them in the garage and keep it hanging on the wall, but actually start to get some liquidity out of their.
That's a big shift that we're seeing. So we've got people coming to us with racehorses, fine wine, art, all sorts of different assets which they think could be of interest to other people, which are not very liquid at the moment, and there aren't it's very difficult to get a venue and to get liquidity around those. Whereas if you open it up into this global infrastructure, you've got a whole generation that's really coming up now, I think accelerated by COVID and people being at home and being more online and digital, who are themselves experimenting with this. It's very, it's something that's very approachable to them and feels very natural. People have their own digital wallets and they're buying and selling these assets online. So that there's a cultural thing happening there. There's a technology. The technology is advancing very quickly. So all these things are certainly coming together and having a bit of a moment right now. These things obviously go up and down, but that's certainly a trend that we're seeing right now.
And these things will settle via a blockchain pretty much instantly. So there's not that lead time in terms of them selling the asset and realizing that asset and moving into a different one.
Mm-hmm.
They could be the day traders of the future.
Yeah, we'll have to come back to that in a minute because there are issues without a central bank digital currency, of course.
Absolutely.
But Trevor, perhaps give us a flavour. Is tokenization a route into enjoying private equity returns, for example, for less wealthy clients of wealth management firms? Is this giving them access to new types of assets, new types of clients? I mean, do you see it happening among the funds which you talk to at MJ Hudson?
I think that's a great point, Dominic. I would just caveat what I'm going to say now. So that I'm only very recently at MJ Hudson. I joined in March. But I think certainly in terms of the points we're making around the democratization of asset ownership, I certainly believe that things like blockchain are definitely going to help with that. Obviously, when you're looking at alternative asset classes and more of a retailization of alternative asset classes, clearly things like private equity come into scope. So yes, on a personal view, I do think that blockchain, similar sorts of solutions, tokenization, will lead to private equity offerings to more retail type investors. And generally, I'm aware of sort of conversations already taking place around the industry to do that. And I certainly saw this sort of democratization, the slicing and dicing of assets in a different way through property initially. And there are a number of blockchains already operating that are offering interest in property in Luxembourg and other jurisdictions as well. So I don't think we're too far away from putting private equity interests onto blockchains and more retail investors being able to participate in the returns that are generated.
And private companies are not just SMEs. Some of these private companies are very large indeed. They need to raise debt, they need to raise equity. In fact, I saw a figure only this morning of the private capital raising in the United States in 2019 was $2.7 trillion. So there's massive opportunities there for the issuers, but also for wealth managers to get involved in investing in those companies for the first time.
I think that's right. I think my only caveat is obviously, and we've touched on it, it's the sort of the ecosystem and the plumbing and whether it's fully developed enough for people to really be able to take advantage of it at the moment. But I think the point I was making earlier, I think you need to have an understanding, you need to have a strategy, you need to understand the issues and perhaps even be experimenting with your own sort of private chain to see how it works and sorts of players. Who do you need going forward? What's the pricing? What are the costs? How can you operate things efficiently, effectively, and still look after your clients as well? But I do think there's a little bit of a way to go before it becomes the sort of mechanism for raising that type of capital and finance. I may be wrong, but I think a little bit more work needs to happen on the plumbing and the ecosystem.
Yeah, I mean, I think there's also this issue of valuation, isn't there? When you start to talk about liquidity, some of the private assets, if you think about private debt and all the kind of bespoke covenants that underpin some of those deals, or even, the process that surrounds pricing in secondary private equity transactions, to get to a stage where you fractionalize that and there's kind of bid offer on that feels some way off, albeit, I mean, I keep, one of the points I come back to a lot on this stuff is, Bitcoin, there's a whole hoopla around Bitcoin, but there are some basic functional fairly prosaic but functional efficiencies that DLT like brings to the table. And you look at things like, you know, large private equity firm universes where they're kind of on their 14th vintage fund, right, which have got all these paper-based interests. It just feels Dickensian, right? So away from all some of the hoopla about, you know, some of the kind of scandals around crypto, there's some basic plumbing stuff which it feels like DLT is really well suited to solve.
I'd agree with that, Andy, and certainly on the smart contracts piece, there have been experiments in the private equity space in terms of drawdowns, etc., and automating those. I think particularly in Guernsey. I think obviously the challenge, and again wearing more of a legal hat, which is sort of my background historically, you know, it's around, you know, particularly liability in terms of, you know, where are those contracts formed, who's responsible, you know, if something does go wrong, you know, who is going to be on the hook for that. But again, I think they're beginning to be some developments there. I don't know if people saw in the last week or so, an entity Law Tech UK issued some digital dispute resolution sort of guidance, which you can adopt as part of your smart contract piece. So, you know, things are moving in the right direction, but I think, you know, connecting back to my other point, that ecosystem and the plumbing is still relatively new, but it's beginning, it's evolving, and the technological ability is certainly there, but the trust and the understanding still needs to develop.
Yeah, smart contracts do not put an end to disputes. Code is not law after all. So that's an important point that Andy,
I think I was going to say an analogy that pops up for smart contracts is maybe self-driving cars. Because, you know, you have a system where you have manual drivers with road signs and police cars, you know, enforcing the law, and you have self-driving cars, which is safer, right? Right now, maybe the driver, but going forward as these things mature. Just a thought, but you know,
liability is a live issue in so many of these things. It is in digital identity, which we talk about a lot here at Future of Finance. Creates liabilities as well. But I'd like to just move on a little bit now. We've talked. There's a lot of opportunities here for wealth managers, but let's talk about the reasons why they're not getting involved. And Phil, perhaps I could pick this up with you. One of the points Andy made is there's no agreed valuation model for this, and of course with a cryptocurrency, there's no cash flows or anything to work with to arrive at those valuations. So the differences between what wealth managers are used to investing in, you know, equity, bonds, FX, commodity, asset classes, and then they're being asked to get into cryptocurrency as well. Now I sat down and sort of tried to think to myself, well, why aren't they getting involved? And you know, it's lack of understanding, lack of expertise. It's and there are infrastructural issues which Andy alluded to as well. And I'd like to stay with those a little bit in a minute. But just tell us, Phil, when a client first comes to you and wants to get involved in this asset class, how much education and explanation are you having to do?
I think with wealth managers, the biggest hurdle is definitely the lack of understanding. I mean, for example, when we talk about valuation, there are many ways where you can value cryptocurrencies. I mean, one of the stuff that we talk about is if you just look at the price, it's just extremely volatile. You know, a lot of people just say, hey, you know, it's just going up, going down, can't really tell, you know, what is the true valuation of the coin? Well, you can look at like the on-chain turnover. You can look at how much network is being utilized. You can take that ratio, just like you do the PE ratio in equity market, apply the same kind of concept. But the thing is, the lack of understanding and just the unfamiliar kind of, I mean, it's a new asset class, right? And it has been driven by all of these kind of, you know, retail enthusiasts and all of these guys who embrace the new technology. So, you know, now that the market cap is so big and Bitcoin's $1 trillion market cap, everybody's forced to look at cryptocurrency now. But the fact of the matter is that there's just so much kind of a difference in the actual understanding of what is blockchain, what is a smart contract. And we talk about this like we know what we're talking about because we do. But for a lot of people, this is all just absolute new technology that they're very unfamiliar with. But one thing that I can say is that the speed at which everything is changing makes it hard to keep up with all the stuff. But I mean, right now, given how much cryptocurrency has grown, nobody can ignore it anymore. I mean, if you don't have it in your portfolio, you missed out on a huge return opportunity. And there's just no more excuse to say, I don't understand, right? Everyone's forced to understand. Everyone's forced to kind of start, paying attention to what's happening. And I think that's going to be the major drive forward.
What about custody? Do clients bring that up as an issue? They'll all have read the stories over the years about, inside jobs on cryptocurrency exchanges, or the hard drive being taken away by the dustman or whatever. Does custody and safekeeping still come up as an issue?
I mean, can I answer that? Sorry, Phil, was aimed at you.
No, go ahead.
Sorry, Dominic. We don't see that, and we don't see that for a very good reason. I think there's an awful lot more confidence in the providers that are offering what we traditionally call custody, but holding the crypto assets. I think there's an awful lot more confidence in those as firms. They're a little bit more known, and as we said earlier, even some wealth managers and institutional firms are now invested in those firms. So they're now quickly becoming market infrastructure, whereas before they were a complete unknown entity.
Mm-hmm. Okay, now let's talk. That's good to know. Do you want to add to that anything, Phil, with that about custody, or feel it's kind of done?
Yeah, I mean, I think it's custody and also counterparty, right? I mean, this as larger institutions come in, one of the first things that we hear is kind of the counterparty risk. Even a lot of these notable exchanges, Coinbase went public, but I mean, if you're a large institution, you're not going to be trading at these exchanges directly. So when you need to source the liquidity and you need to face somebody, there's this kind of and going back to the whole regulatory point, is it FATF compliant? Are they regulated by any regulatory authority? And there's the fact of the matter is that a lot of people feel uncomfortable facing certain counterparties and also trusting the custody on some of these counterparties. So I think it's been a big hurdle, and even now a lot of the really larger institutional accounts and wealth managers feel probably uncomfortable because they don't know who to face. And that goes back to my whole point of understanding and a basic lack of knowledge of who the major players are in the crypto ecosystem.
Andy, since you brought this up originally, we talked about custody, which is one aspect of the infrastructure that people have to deal with. There are lots of other things, the issuance, the trading, the settlement. And I think that however this marketplace unfolds, and I'm talking here of security tokens as well as cryptocurrencies, we're going to get lots of different networks based on blockchain and maybe based on other technologies. But even when they're based on blockchain, sometimes it's difficult for these networks to interact with each other. And if they can't interact with each other, that's going to affect liquidity. We need a marketplace in which people can move easily between exchanges, if you like, and between asset classes. And we learned at the end of last month about this very interesting initiative called FinP2P, which is to create a protocol to enable orders to flow between these different changes, which will create that secondary market liquidity, which will in turn drive more issues and help the market take off. So if you were advising a wealth manager today, would you describe infrastructure, operational infrastructure, as a major barrier to entry or not?
Yeah, I mean, that's a very complex kind of interoperability kind of question, isn't it? I'm gonna take a few steps back and just come at it from a kind of more basic wealth manager perspective. I mean, what I see in the market is wealth and asset managers, which often go together, right, are under massive kind of margin and cost pressure, right? So they are arguably the market's, well, it's undersupplied in some ways, oversupplied in kind of other ways, but they're going through massive cost rationalization programs, right? At the same time, they recognize that they need to be innovative. I think, often we talk about crypto and security tokens as digital assets. If you speak to wealth managers about digital, they are more in the weeds about the digital. For them means like digital marketing. It's about how do they augment their advisors and make the onboarding process a bit easier. So I think there's a bandwidth challenge for wealth managers, and they're kind of just trying to work through their own plumbing issues, right? Their own much more basic plumbing issues. But I mean, Phil's right. I think they're looking out to the market and seeing this wave of interest and volume and value creation and destruction, but a lot of value creation. and they're rightly being challenged by their clients to engage. And I think there is a massive, but there's a massive education exercise which needs to go on both for the wealth managers and their clients. I think the challenge is the wealth managers at the moment are a bit underpowered in terms of being the right people to explain to their clients. Because I do think, to go back to that barbell concept of, you had effectively retail day traders, perhaps the wrong phrase, at one end, and then the ultra high net worths kind of perhaps getting ICOs and other coin offerings. For the mass affluent, I think they see the Bitcoin soap opera and they get put off by that. But I think there's a gap at the minute in the market in wealth managers for people who can understand and explain to clients to help them get their heads around this.
So, Jeff, that sounds like bad news for you, that the wealth managers haven't got any money to buy your systems.
I think it's really good news, because they probably don't want to invest in their internal infrastructure, nor do they need to, because they will go to an Avalok of this world that we could provide that infrastructure. And for me, it's very much like if you started whether it's an institutional broker or wealth manager today, you would not go and buy a back office system, appoint a custodian, you'd outsource that. And I think it's the same in this crypto space as well. You will find the market experts, and then you will outsource to them and let them run that market infrastructure. I think the wealth managers' challenge from a technology perspective is I think you touched on it, Andy, their own internal systems. So if they're investing in cryptocurrencies, then they need internal systems that can deal with that volatility by the hour, by the minute, by the second, whereas maybe they're used to long only type of assets that they price once a day and they reflect that once a day. So they've got some internal plumbing to get right. I think the external plumbing, they can leave to experts in the market like Avalok.
And I'd like to, what would really solve this problem is a very clear client appetite to invest in this asset class. Addy, are we seeing wealth management clients putting their wealth managers under pressure to invest in cryptocurrencies, security tokens are a bit difficult to get at these days, but non-fungible tokens, for example, they could have a go at those?
I imagine that there's some pressure just because of the movements in Bitcoin and cryptocurrencies and so on. I imagine that's where the pressure is coming from. But I would turn it around a bit and say, for an asset manager, a wealth manager, ignore the changes in the space at your peril, because it's not just about cryptocurrency. We're seeing different forms of tokenization and digitization of money. We've mentioned central bank digital currencies. We have stable coins and we have cryptocurrencies. And it's probably fair to say it's inevitable that we will see digitized money of some form on this type of infrastructure in widespread use in the next decade. And the mechanisms which are evolving and flourishing now in the crypto space are likely to be the same. It's likely to be similar plumbing that we can use regardless of whether it's central bank issued tokens or other types of sources. So I would say really educate yourself on what's happening right now, because it's moving very quickly and some very interesting things are evolving there.
Trevor, any sign of a particular type of wealth management client getting involved in this? Is it the ultra high net worth, the high net worth? We've touched on mass affluence becoming accessible through these instruments, but are there patterns yet about what type of client is pushing their wealth manager to do something?
That's not something that I'm particularly plugged into, Dominic, so I can't answer that directly. But clearly, what I can see through all the things that are happening at the industry level is that regardless of exactly where your client sort of center is and the sorts of clients that you work with, this is clearly really, really important stuff. And you will get left behind if you're not thinking about these issues and looking to deliver to those clients. I'm seeing so much change in this space almost daily. I think it was either Addy or Phil mentioned that a little bit earlier. Credit Suisse and Instinet partnered up a few weeks ago to settle stocks on a blockchain, and they managed to do that within minutes, hours, as opposed to sort of a T+2 settlement. You've got the Bank of England potentially getting into things, and clearly, if they set up a new form of digital payment system, that's going to have lead to different roles for banks, for example. So there's so much going on. You ignore it at your peril. You've got to get your head around all the operational resilience and all the other issues that we're touching on. But others may be have a little bit more information, Dominic, in terms of actually zoning in on the actual client type. But I'd be very surprised if it was one or the other, or none at all. I think it's got to be across the board.
Mm-hmm. Now, we've talked already about how wealth managers are, the more pioneering ones, are accessing this asset class, not just directly, but through funds, through AIFs and through ETFs. They're also investing, as somebody pointed out, that Bailey Gifford, is investing in doing the classic trade of investing in the people selling the shovels in the gold rush rather than buying the gold itself. So those things are clearly happening. But are there is it possible, and Phil, you'll have a view on this, is it possible for a wealth manager to sort of look at cryptocurrency and at security tokens, think to themselves, well, this is just another asset class. We can apply all the same criteria we do. We need diversification, we need non-correlation, we need to hedge our risk, we need to get some yield, and all conventional asset management criteria do apply to these asset classes. Right or wrong, Phil?
I mean, 100% is correct, right? I mean, if my background was in systematic market making FX at Goldman, and then we just transferred everything that we knew and everything that we've kind of worked with and applied it to crypto, and it works. Mm-hmm. So, and I think that's the thing. A lot of people feel that cryptocurrency is very different, but at the end of the day, it's the same framework that we work with in all the other asset classes. So when we hire people, and that's the other thing, right? Given the market cap and given the growth in crypto, you have all the traditional finance guys coming into crypto very rapidly, and I think this is very important. It's no longer this kind of this techie kind of guys. We see a lot of familiar faces in the crypto ecosystem now because it's where the movement is, and it's where the market cap is growing, and it's where the returns and all the focus are. So in that sense, I think that any wealth manager or any client base are going to feel very familiar dealing in crypto, because at the end of the day, I think you're going to be dealing with all the guys who used to trade commodity or FX or equity now in the crypto space. So that's an important point.
You're an FX guy, and in a sense, cryptocurrency appears to you it's like another currency. Wealth managers famously not very good at managing FX exposures, FX risks, or even FX prices. Is that not a barrier for them to investing in cryptocurrency? Do you not find that is something where we just don't know how to do that still?
Yeah, but I mean, at the same time, we talked about Jpmorgan launching their fund earlier in this call as well. So there are all these kinds of solutions and products that's being produced. I come from an FX background. Crypto is similar and very different from FX as well, right? At the end of the day, crypto's exchange driven. FX is very OTC driven, and I think that bottom line, the necessity drives the kind of all the invention and innovation. So I mean, we are going to see ETFs, and we are going to see all of these other products in the crypto ecosystem that's going to make it easier for the wealth managers to kind of get exposures into crypto. So I mean, I think we're already there, right? And we're already seeing it. So.
Mm-hmm. Now, let's into our last 15 minutes or so. Perhaps we could talk about what wealth managers should actually do in these marketplaces. And I'm thinking here primarily, I suppose, of security tokens, but also cryptocurrency. And a bunch of things they could do. They could do execution. They could make it act as brokers for their clients to buy these asset classes. They could do custody. They could run digital wallets so you can safekeep your assets with them. They could get involved in settling these transactions. And as I think Andy and Trevor were both saying, at the moment, until we get a central bank digital currency, you can settle against payment tokens on the chain. But if you want to get your fiat currency out, you've got to come off the chain and go through the banking system. That in itself is a job which somebody needs to do. But they could also get involved in more exciting things like prop trading. They could start getting involved in structuring the funds, which they could then sell to clients or distribute to new clients. They could start doing lead broking, in other words, acting as the counterparty when nobody else will stand there, particularly if they brought an issue to market. they could start to build, security token marketplaces. They could start to own or operate them. So there's a whole spectrum of things which wealth managers could do. Jeff, what do you? I mean, you provide an all singing, all dancing platform to wealth managers. Do you find that they're interested in buying the whole soup to nuts, or do they want to pick bits out of it according to their risk appetite?
I think it depends, and we deal with global wealth managers and right the way down to startup organizations and the likes. It's a really difficult question. My personal view, I don't see wealth managers getting involved in buying those assets and holding them and acting in like an institutional broker. I think they focus on their clients, the value to their clients. I think, to Phil's point, everybody needs some of the cryptocurrencies in their broad range of portfolio to make it wide range. I don't think you can ignore it nowadays. I think if you're just buying funds or equities or ETFs, you're getting a return, but sooner or later your competitors are going to start being creative about having cryptocurrencies in there and getting really good returns. And that's what the wealth managers really care about, is the returns to their end clients. Mm-hmm. I don't see them being too adventurous in the short, medium term, if I'm really honest, Dominic. I just don't think that's the nature of who they are. I think they'll be very conservative. I think they'll probably be driven by the market maturing, and maybe they'll dislike me for saying this, what their competitors are doing. I don't see anybody having a digital cryptocurrency strategy and putting that at the forefront of their investment solution to their clients. I think it's part of that investment solution, but it's not the main part of that. I see tokenization as being completely different, but as you say, that's 2 to 3 years down the line.
Mm-hmm. So taking principal risk is not something that we expect them to be doing.
I just don't think it's the model.
Yeah. Phil, how broad a range of cryptocurrencies are? Let's talk about your institutional clients as a whole. How broad a range of currencies are they just focused on the top 3, or are they straying further down the list of crypto to look what's happening there?
Right. For institutional clients, 100% they're focused on the top 2, top 3. And we can tell because, we see the volume breakdown. And, there are some of the more kind of adventurous, hedge fund types that really goes into the altcoins or all these other kind of, instruments. But at the end of the day, I think right now, at least, up until this year, right, up until May of 2021, the main driver has been Bitcoin. But in the last month or two, we've seen kind of range and consolidation, and we started seeing this is the thing. Once the client base is familiar with the crypto instruments and the cryptocurrency, now they can kind of venture out into Ethereum, which is a smart contract based, and all these other kinds of coins. So what we noticed is that when the big institutions came in, they were all about Bitcoin. And now they're starting to look at, what is DOT, what is Link, what is Ether, and everything else. So again, the key message, I think, is the speed at which once you start dabbing into crypto, and then you start realizing there are smart contracts, DeFi, STOs, and everything. I mean, it just moves so fast. So I think right now still the top 3, but I think that's going to change very fast.
Mm-hmm. Addy, you were nodding. Did you want to add to what Phil has said?
I think it's very true. If you just look at the gains, then you look at Bitcoin, but Bitcoin is almost a dumb asset here because you can't do very much with it, and the sophistication of the applications and a lot of the really interesting changes and developments and efficiencies that they're really coming through on some of the other platforms, through especially Ethereum and some of its variants. So yeah, the deeper you go, the more you'll see that's happening right now. And even though it's very early, there's a lot of breadth there already.
Yeah, and Adi, you made a really interesting point earlier about liquidity and how effectively we're getting new pools of liquidity forming. And it almost strikes me that, to the point that Jeff was making earlier, it's not really ever been the function of wealth managers to kind of book run that much, outside of being part of an integrated bank. They're much more about building, bringing together exposures for clients and running portfolios and servicing those. So the really interesting thing, it strikes me, is particularly if you then add on the bandwidth challenges with which wealth managers are facing, there is a massive space for challengers and new entrants to come in and create new markets with new exposures, which will then be effectively harvested by the wealth managers and put into client portfolios or blended in client portfolios. And I think what's really interesting, above and beyond the kind of cryptocurrency is the versatility of the technology, and therefore the kind of the range of different markets you can envisage springing up. And I guess what goes with that is, and this is one of the general features of technology, isn't it? The ability to bespoke for individual clients. And once you start to think about fractionalization being applied to different asset classes, you could see, blends of exposures to all sorts of things to which people don't currently have exposures, like Mayfair hotels or art or wine, or there's this crazy stuff, Eddie, about sports memorabilia, which I can't get my head around, but this incredibly valuable market in NFL programs or whatever it is. But, you could imagine a world where you get entrants coming in, creating pools of liquidity around those new markets, opening up whole worlds of exposures we haven't seen yet, I suppose, is the bright, shiny world view, right?
I read somewhere that 80% of sports memorabilia is faked. Maybe there's a role for authenticating sports memorabilia.
There you go, that's DLT. It's right for DLT, isn't it?
but I'm glad you brought up the question of how wealth managers can actually start to create whole new markets. This is a particular I was going to say enthusiasm, but it's probably a bugbear of mine, that we talk about the wonders of being able to tokenize things. There's all these illiquid assets lying over there. If only we could tokenize them, we could sell them in bits to all these people over here. But the piece which makes the conventional security markets run, the investment banks in the middle who find the clients, structure the issue, make sure it's tax and legally compliant and regulatory compliant, it's not sold to the wrong people, that piece of work is often forgotten. And it's not principal risk you'd be taking on. It's purely advisory work. There must be private banks out there who could do actually a very good job, because they've got the clients who own the illiquid assets. They could start to advise them how to tokenize those, how to turn them into token issues, turn their real estate, their forests, their fine art, their sports memorabilia and their vintage cars into these. But are we, I don't know whether Jeff, you're probably the person most likely to see this going on. Do we see wealth management, ultra high net worth wealth management clients pressing their private banks and their wealth managers to get involved, saying, "Look, I'd really like to tokenize 49% of my Gauguin on the wall. Can you help me?"
Short answer is yes, and I think it's been the goal of the wealth manager as well, which for many years they've talked about the holistic view of the client's wealth. Well, that's normally only assets that you can price, value and trade fairly easily. So absolutely, and property obviously you can hold within portfolios, but you're absolutely right. There is a marry of a very ambitious client and a forward-thinking private bank or wealth manager that will come to market and say, we're going to revolutionize the experience for our clients. I think the technology exists today. I think that it's starting to mature. It's starting to become a little bit more mainstream. And I think maybe a few years ago, no one could see that happening in a way. And the DLT helps that, and I think once you can digitize, I keep calling it digitize, tokenize those assets. I think that's the revolution. And then of course, you can pay with them with your cryptocurrency, but I'd see the tokenization being a bigger wave than the cryptocurrencies, if I'm honest.
Do they ever worry that they will actually lose assets? Assets might start to flow out of the business rather than flow into the business
I think
as a result of tokenization.
I think wealth managers have always got that worry that the moment they go to their clients and say, "Let's go through your portfolio," I think being a front runner in this, I think would give them real market advantage. I think 2 or 3 of the wealth managers or the private banks doing this would really give them. I think it'd have the opposite effect. I think it would attract people to them because they'll be so far ahead of their competition.
I wouldn't underestimate the custody part of that as well. So I think people trying to do things on their own, there's an element of this technology which people really most people wouldn't know how to handle, and I think having the custody taken care of, as well as the knowing how to deal with the market.
Because
Andy, it won't surprise you to say that we would do that for them, but we won't
because
surprise
it's
you.
technically complex to safekeep and transfer private keys to digital assets. Is that what you mean?
Yes, yeah. So I mean, this is really originally kind of developed by developers for developers, you know, for techies, and so most people wouldn't know how to deal with their keys. And for technologists love this because it gives them control of the keys. But for the average person on the street, that's very difficult to get their head around.
And Dominic, just on the key factor, I keep interrupting, so apologies, everyone.
Yeah.
The keys are really important, because if the wealth manager or the private bank don't own the keys, they get disenfranchised effectively. So they they don't really have true custody. They have a book and records that says what they have, but they don't really have custody in the true sense.
Yes, it belongs to the customer in a way, doesn't it? They're ceasing to intermediate it in some way.
Absolutely.
Well, we're down to our last 5 minutes, so perhaps we could spend that 5 minutes just asking ourselves one big question, which is, we've established that this is a great opportunity for wealth managers. We've established that there's a bunch of barriers which they need to overcome, both in their own minds and in terms of the available technology, and in terms of the minds and behavior of their clients as well. But I think we are agreed that this is going to happen. We might disagree about the timetable on which it's happening. It's clearly happening already in cryptocurrency. And what we've learned about digital technology, if it starts in security tokens, it will probably scale very, very quickly. And they could well find that all those stocks and bonds they're buying today are available only as new issues in tokenized form within the shorter period as five years from now. So this is something they need to do something about. Now, my question is this: if they don't seize this opportunity, do you think somebody else is going to seize it for them, or will they retain the client base and be able to slow down progress towards the future which we've described here? And Trevor, perhaps I could very unkindly put that to you first.
Yeah, I'll take a stab at that, Dominic. And my personal view is, I think the answer is yes. I think other people will come in, disruptors, but probably what you'll see initially is a little bit of a hybrid approach, perhaps, where you'll have some maybe a couple of wealth managers that are ahead of the game, and some new entrants that are on top of this sort of technology and these approaches, which maybe some wealth managers' existing customers will go to just to sort of test the waters about. And then over time, you probably will see those clients, bring all their assets across to particular wealth managers that are able to cope with all the technology. So I would say it's going to be a bit of a hybrid initially, but will drive some structural changes over time.
Thanks, Trevor. Andy, 35% of UK fintechs are actually wealth techs. There's a horde of disruptors waiting in the wings. What's your prediction for how responsive the leaders of the wealth management industry in the UK anyway will be?
Yeah, well, I think it's a famously sticky space, isn't it? I mean, you've got these client relationships built up over a long period of time.
But sticky to the advisor.
That's right.
Yeah.
That's right, but
fintechs have got the know-how and they've got the clients, and if they can detach the advisors, they might detach the business, right?
Yeah, but I've got to think there's a bit of an element in all of this is some of the points we were talking about earlier about education and communication. You kind of think that wealth managers that don't get on board with actually understanding the total universe of investments which are available to their clients, including digital assets in all their forms, are ultimately going to be less competitive in the market. And there is a place for people to come in who actually understand this stuff and can communicate it. And maybe that's a rebrand of part of a wealth manager, because they are very entrenched relationships, but it feels like there is space for some newer entrants to come in and just start talking about this space in a way that others are not.
Addy, I think Andy was really trying to say the ones that don't get up to speed with this deserve to fail. Do you think that's...
Well, I mean, that sounds a bit extreme, but I think, there's definitely something to it. I think if clients have to start going elsewhere because they're interested or to educate themselves or to learn more or to gain more from certain products. You know, they're creating a relationship elsewhere that might blossom into other things, and that must be a threat.
Mm-hmm. Phil, give us your prediction from where you're sitting. You're actually in a very good position to see what's going on.
I mean, the fact of the matter is, in 2017, there's a lot of investment banks that were getting pressure from PWM, from private wealth management, to get into crypto. A lot of the internal controls, or there was hesitancy in investment banks, right? We saw these headlines: Goldman Sachs might do crypto in 2017. Jamie Dimon commented and said, we're not going to do this. Let's look at what's happening now. Yeah. And what happened is, in 2017-18, all of these guys fled investment banks like myself and came into crypto. And now we're seeing this massive kind of influx from all of these places that's choosing not to adopt or choosing not to engage. So, you're forced to be engaged. You're forced to be, involved. Otherwise, someone else is going to just take the place. So.
Mm-hmm. And just before I let you go, Phil, are we seeing people coming out of hedge funds to get into security token and cryptocurrency fund startups, as well as you're getting that same movement of people who know what they're doing into the sector and applying their knowledge and skills and experience to these new asset classes as asset managers as opposed to traders?
I think the biggest exodus is actually from investment banks. Hedge funds, not so much, but like right now, we're obviously always recruiting, for traders and different kinds of people. But what we see is that there's just massive exodus from investment banks to come into crypto ecosystem. In particular, yeah.
Well, Jeff, it falls to you to answer the question which we've now had from a member of the audience, who says, it was more of a comment. It would seem that this will remain an investment opportunity for ultra high net worth and high net worth rather than mass affluent at this stage. The wealth manager will be concerned on liquidity issues and remain a problem for some time yet. Sophisticated investors will be needed for the regulator, I suspect, in the same way as for hedge funds. Therefore, funds and ETFs must be the starting point. That audience member has clearly been listening to our discussion. Do you think that's a fair comment on everything which we have said? In other words, if you link that to the question I wanted to close with, is this the death knell for wealth managers who don't keep up with this, but also creates an opportunity for those 35% of UK fintechs who want to move into this space to find the right partners, and they could have a very successful business? But it sounds as if they're going to have to start with something quite conservative, with some very rich clients going in through established vehicles like funds. Do you think that's a fair assessment of the short-term, immediate future?
Is yes to a simple answer? Yes.
You are allowed to say yes. Hardly anybody does on these webinars, but you can say that, yeah.
Yes. I think any wealth manager or advisor has to take cryptocurrencies, crypto assets within their portfolios and their business model in the future. As you rightly say, Dominic, in the future, if they want to buy, you may have corporate actions that are all tokenized, so they can't ignore it. It's going to be part of market infrastructure probably in the medium term, definitely. I can see the ultra high net worth clients and wealth managers not moving from their wealth manager that expect them to support them because there's other services that they offer. I do think you've got disruptors. Maybe the banking disruptors will go into investment, and they could really attack the mass affluent, the ones that only want a service on their smartphone. And I think that could be where that tokenization really makes a difference.
Mm-hmm. So he's wrong to think it's only the ultra high net worth. This could be a mass affluent product. Eventually,
yeah. Sorry, I don't want to contradict the comment, but I think in the short term, he's absolutely, or she's absolutely right. I think in the longer term, I think there's other options that could come into play.
Yeah. Anyway, we've run 3 or 4 minutes over, so we better stop there. I'm sorry, you can see this discussion could go on for some time. I'd like to thank our panelists: Adi Ben-Ari of Applied Blockchain, Phil Gillespie of B2C2, Trevor Goodman from MJ Hudson, Jeff Harvey-Wells of Avaloq, and Andy Knox. And I'd also like to thank you, our audience, for your interest and for that comment. Our next webinar it's not actually a webinar, it's a different type of event, Thursday next week, 6th of May, at our usual time of 1400 London time. The subject's a bit different, as I say. We're talking to Stepladder, a startup which has reinvented the Victorian Building Society. They're going to be talking about their crowdfunding project, which is live right now, and I hope that some of you will be able to join us then. It's an interesting practice run, if you like, for investing in new types of companies and new types of assets. But for now, it's goodbye from the six of us.
Thank you for joining us. You can find this discussion on www.futureoffinance.biz and indeed other planned webinars under current events. I am Wendy Gallagher. If you would like more information about how to work with us, please do email on wendy.gallagher@futureoffinance.biz. Thank you once again.